I don't think people were anticipating much from this meeting except for watching the dot plots and that summary of economic projections. The last time we got this from the FOMC was in December, and it was a very different macro environment then. We look now where GDP expectations are 1.5% to 2% higher, inflation expectations are higher as well. Unemployment rate actually has a lower expectation than where we were back in December. So the question is going to be, do enough members of the FMC move their dots, move that expectation for rate hikes in enough to where the market is going to react? If they do, Powell is going to have a very difficult time in the press conference trying to walk that back and calm the markets down, because we would see rates in the Treasury market move higher, not just in the 10 to 30 year, but down kind of in that belly of the curve to 5 to 7 year would move higher as well. And we've seen the reaction the equity markets had to rising rates over the last couple months. That's what people will be focusing on.
Of those rates rising, certainly a concern to a lot of people on Wall Street. Let's also talk about inflation. There are expectations that the Fed will clarify its inflation target. Do you think it stays at 2% or will it change?
No, Frank, I think it stays at 2%. But the big question, and one of the reasons we saw some volatility the last time Powell spoke in his interview that he had about a week and a half ago, is because the Fed is adamant that this is going to be transitory inflation. And I think many people are expecting the Fed to come out and, if not actually do something with rates or with their bond buying program, to at least verbally acknowledge that the inflation could be something more than transitory, more than just base effects, and more than supply chain issues. I tend to think we're going to see inflation go north of 2% for the next quarter or so, but then come back down later towards the end of the year. So I am kind of in the Fed's camp of transitory inflation, but it's definitely going to be a key to how Powell addresses the market. So
about 20% of the market seeing 52-week highs right now. So let's talk a little bit more about stocks. You're very bullish on mega cap tech stocks like FANG names and things like that, but you're even more bullish on what you call growthier names. Can you give us a couple examples and kind of explain what growthier means?
Yeah, so I think a lot of people get caught in the whole growth versus value concepts, and they forget that there are names that really don't have to be one or the other. They can be both. So for us, an example, we've talked about it before, is McCormick, the spice company. Many people consider it a value name, but yet it has consistent growth every year, around 2% growth. And people don't realize, our equity portfolio manager always says, do you know the price that you paid for cinnamon last year versus this year? We really don't, but the growth component is there. So yes, we like the tech names. NVIDIA is a name that we have bought recently. Broadcom is a name we've bought recently, but we think you can look in other areas as well and find names that have growth but are not necessarily in that growth bucket.
All right, Victoria, before we let you go, I got to ask, are you more bullish on those stay-at-home trades, or do you think the reopening trade is the place to be right now? We're obviously seeing that performance by the Russell outperforming the other indexes.
Yeah, I think a lot of it depends on what you're, if you're trading short term or long term. For long term, we still like those longer term trends in 5G and data infrastructure. Short term, obviously the reopening trade has some momentum. We would play that with names like Visa or MasterCard.
Shepard Smith here. Thanks for watching CNBC on YouTube.